So I know a lot of people are always scared when the stock market is going down, but honestly, it doesn't always go down that much. It's very slight. Everybody's saying it has crashed, but it has only gone down about 4% of recent, but everybody's like, whoa, we're dying. So the first thing to do when there's a bear market is you can just stay out of the market. That's the first thing to do. Just stay out of the market. That alone helps you preserve your capital. So the trick in investing is actually not to make the most money because you can see the gains are the same. The trick is to not lose money. Welcome back to the channel. Today, we're going to have a good time. As you can see, the stock market has been crashing. If we look at all of the sectors, apart from the consumer non-durables, everything is not looking good on a weekly basis. If we look on a daily basis, we had a very bad day last Friday. And as we go into this week, what is going to happen? What's going to happen over the next month? We don't really know. But in this video, I'm going to show you the very scary signal that I am seeing in the stock market, in the S&P 500. It's a very strong bearish signal. That's the first thing that we're going to look into. I'll show you the 4 other times that this signal happened in the stock market and what happened when this signal came. And then we shall see what to do when we are in a bear market. So I know a lot of people are always scared when the stock market is going down, but honestly, it doesn't always go down that much. It's very slight. Everybody's saying it has crashed, but it has only gone down about 4% of recent, but everybody's like, whoa, we're dying. But anyway, the first thing that you can see is that there is something like a double top happening, right? If I'm to draw a line here, you can see it's like the market is having some sort of double top. It has failed to clear out the previous high and is falling down again. But that's not the scary signal. The scary signal comes here in the relative strength index and the composite. After we've seen the double top, another signal that is a little bit very bearish is that we can see that this big red candle has closed below the lows of all of these weeks. And then on the relative strength index, what you can see here is that I add moving averages. So green means that the relative strength index is trending up and red means that it is trending down. So one very strong bearish signal is that once the relative strength index first turns red and then the relative strength index attempts to go up and then fails, as it's doing here, it tries to go up and it fails, that is a very bearish signal. Also, we can see that in the composite index. The composite index is basically a relative strength index, but it is not restricted to stay from the range of 0 to 100 because relative strength index is limited from 0 to 100. So this one has no limit. It can bypass 100. It can go below 0. And then that helps us find signals that we couldn't see in the relative strength index. We can see that it has just crossed red. It has turned red. And then once it turns red, it fails. It fails right after it turns. This is a very strong bearish signal. Now, I'm not sure if we're going into a bear market. We can never know the future of the stock market. And there's nobody out there that knows the future. But once we see a bear signal like this, we have to put our guard up. So which other times in the past has this bear signal happened? The first time it happened, the most recent time it happened was in February of 2020. So we can see what happened during that time. Yeah, this is one of the times. So you can see it's going down and then it fails right at the moving average, right? This was before it turned red, but this is also the same strong signal. We can see that the averages went up while the relative strength index here and the composite, they went down. So that was a very strong bearish signal. And then this made the market dive from the top to the bottom, just a 33% dive. So that was wiped out. We all know what caused that. So let's go into the next signal. And that was in July of 2015. So July 2015. Yeah, we see a very similar signal in the stock market. Here we put the charts together. This is the weekly chart. This is the daily chart. We see the stock market fails to clear the highs, the relative strength index and the RSI, they fail. It turns green and then it turns red. And as soon as it turns red, it fails on the moving averages. So we can see it here too, a very similar signal to what we had. And then once it comes, we can see a 12% drop from the top. So 12% drop is not so bad in your account. Now, it sounds scary, but I don't think it's a very huge drop. That was another signal. And then the previous signal again from that was in September of 2014. So let's see. Again, we see a very similar signal here. So you can see the stock market here, it did clear the highs. So that was good. Everybody was happy again. But then as soon as it comes, the composite turns red. I'll make it bigger for you to see. And the RSI also doesn't have a very clear signal, but we can see a clear signal on the composite. Turns red, fails, comes down. And then this one had about a 10% drop. So we can see an average of about 10%. So we had 10, 12, 33%. The next one was in April 2011. So let's see, April 2011. Let's go back to April 2011. This is July, March, April. Yeah, so I like this one. This one is a good one because it's very similar to what we have today. So we can see that the stock market first fails here, right? From the top, it first goes for 8% dive. Then it returns back. So it fails here first, it returns back. And for the second signal, we see it also fails. While the RSI is red, it fails and comes back down. And also for the relative strength index, we can see it failed at a very critical level. Whenever you see a stock or any kind of index failing at the 60 level in the RSI, that is a very strong bearish signal as well. So it fails at a 60, it forms an M pattern, which is a very strong bearish signal. We haven't seen that yet, but we can see an M pattern here, and both the M's are around 60. And this one also goes for quite a huge dive, or should I say 20%. So we saw a 20% loss, 10% loss, 30% loss. So we're not sure what's going to happen today. But if I was to guess, conservatively, I would say from the top, it might do a 10% drawdown mid the previous lows. That's what I'm thinking is going to happen. I don't think we can predict the future, but this is what I think is going to happen. But the reason why this time it looks a little bit strong as well is that the RSI and the composite, they're both showing the same signal. So they're both turned red, as we can see, and then it's failing while they're both red. So the last time also this kind of happened, we can see it here. It failed to clear the highs. So they're both failing as soon as they turn red. You can see actually the RSI is still green while this one is already red. So after that, the question we have to ask ourselves is, what do we do when there is a bear market? So the first thing to do when there's a bear market is you can just stay out of the market. That's the first thing to do. Just stay out of the market. That alone helps you preserve your capital. The second thing to do once the stock market is crashing is a bit for advanced investors is to short the stock market. And while the stock market is crashing, not all stocks are shortable. As we can see in the heat map, you don't want to be shorting like Procter & Gamble or Coca-Cola or Pepsi. You want to be shorting things like Nvidia, Google. These high flyers that were going so high in the bull market, they're the ones which come down strong when the bear market comes. So the second thing to do is shorting. And if you want to learn how to short, you have to watch the next video I'm going to release today. That is where I'm going to teach people how to short the stock market. And after that, then you can see what happens when you get out of the market. So I have a table here. We can see two accounts. They start off with 10,000. One is for a trader with uncapped losses. One is for a profitable trader who caps his losses at 2%. They all have the same gain, but their losses are different. So we can see they all start off with a 5% gain. Great. Then the next time, let's say these are yearly returns for the stock market. The next time, this one has a 2% loss because when the short market is going down, he either shorts to cap his losses or he sits out so he doesn't go through those really bad losses. So he sits out, this one gets a 10% loss. Then the next time stock market goes up, they both get 8%. So over time, you can see that for the same gains, one is ending up with a negative 17% loss and one is ending up with a 35% gain. So the trick in investing is actually not to make the most money because you can see the gains are the same. The trick is to not lose money. And once most people understand this, that is when they're going to become profitable. If you like information like this, I urge you to like this video, subscribe to the channel, and also sign up for my newsletter where I'll be teaching you all of these tactics for free. I watch the market every day. I'll be keeping you updated on the latest moves and what you can be doing for your portfolio for the greatest gains. Thank you.